Somebody has a very distinctive voice, so we'll ask that person to bring the level down, and everyone else can follow. Today, the committee convenes a public hearing. This is the first of a series of hearings which will be held in our oversight capacity as a result of the well-publicized events surrounding the Daiwa Bank and Daiwa Trust Company. On November 2nd, the U.S. banking regulators took the unprecedented action of terminating all of Daiwa's banking operations in the United States. On the same day, the U.S. attorney filed criminal charges against Daiwa. The events at Daiwa point to a disturbing picture of illegal conduct, cover-up, deception, and inefficiencies. This picture includes collusion and cover-up by a foreign bank, its senior managers, and inadequate supervision by its home country supervisors and U.S. regulators. In the aftermath of BCCI, Barings, and now Daiwa, the integrity of the global financial market has been seriously undermined. This Daiwa episode is highly troublesome for several reasons. First, foreign banks contribute a great deal to the economy of New York and the nation, and this scandal may undermine public confidence in foreign banks that operate here. The American people need to know whether this was an isolated episode of a rogue trader and the corrupt or incompetent senior management of one bank, or whether the problem at Daiwa are more widespread. Second, it has shaken the confidence of the Congress and the American people in our scheme of foreign bank supervision, including our policy of national treatment that welcomes foreign banks into our country. It has also exposed a serious breakdown in the U.S. supervision of foreign banks. Third, Daiwa demonstrates that inadequate supervisory attention by U.S. and foreign regulators has the potential to undermine one of our greatest national assets, the U.S. financial system. Our system of regulation is the bedrock of the integrity and confidence enjoyed by U.S. financial markets. Foreign banks that defy our laws must have their privileges to operate in the U.S. revoked. And I want to commend our regulators for their firm and swift response in connection with this matter. Fourth, the Japanese Ministry of Finance's complicity with Daiwa's senior management in withholding material information from U.S. regulators is a serious breach of trust between our governments. Under the law today, the Federal Reserve must evaluate whether a foreign bank is subject to consolidated comprehensive supervision in its home country. If this episode is characteristic of the attitude of Japanese regulators towards compliance with U.S. laws, I seriously question whether there can be any basis for trusting and relying on the finance ministry of the Bank of Japan. In the last decade, Japan's share of the U.S. banking market has doubled, exceeding $780 billion in assets. This has occurred only because U.S. financial regulators believed that they could rely on the Japanese authorities for mutual trust and cooperation. The role of the finance ministry in the Bank of Japan has severely shaken those essential beliefs. I'm amazed that the Japanese authorities still have not recognized that a serious mistake was made and that the Japanese government has not issued a formal and public apology to our government. The recent events surrounding Daiwa have clearly eroded the confidence and trust of both the Japanese and American people. To restore that confidence, the Japanese banking system must remove the cloak of secrecy it has been operating under for so long. Our global financial markets depend upon trust and confidence. We must all work together to restore this trust. The American people must have absolute confidence that any bank operating within our shores is carefully regulated and financially sound. On October 19th, I sent a letter to Chairman Greenspan expressing my concern about these events and requesting a complete and detailed report about Daiwa. That forthcoming report and these hearings are a part of this committee's comprehensive re-examination of the current scheme of foreign bank supervision. The committee will receive testimony today from Daiwa's U.S. supervisors, both federal and state. Federal Reserve Board Chairman Alan Greenspan, FDIC Chairman Helfer, and New York Superintendent of Banks Neil Levin will help this committee understand what happened and how we can prevent it from happening again. The committee recognizes that their public testimony will be limited in deference to the open and ongoing criminal investigation. The U.S. Department of Justice has also communicated its concern to the committee in conducting its constitutional oversight responsibilities. The committee will be mindful of these concerns as it proceeds today and in the future. I have been personally contacted by the U.S. Attorney, Mary Jo White, and have assured her that we would withhold from bringing forth various witnesses at this time. But there will be a time when we will bring them in and examine in detail exactly what took place at the institution. Senator Bennett, before I turn to our distinguished panel.
Thank you, Mr. Chairman. I don't have a formal opening statement. I want to thank you for holding the hearings and thank these distinguished witnesses for coming to help us understand this issue. Excuse me. I've done business in Japan. I've had bank accounts in Japan. I probably would have been better off if I'd left my money in yen rather than converting it to dollars and bringing it back into the United States. But for that reason, I have some understanding of Japanese banks and enough to know that I need to be here for the hearings to find out more. So with that, Mr. Chairman, I thank you for the leadership in holding the hearings and look forward to the comments from the witnesses.
Thank you, Senator. Chairman Greenspan.
Thank you very much, Mr. Chairman. I have a rather long prepared testimony and request that it be included in the record.
We'll take the entire statement as if read in its entirety so that you may be able to summarize.
Thank you very much, Mr. Chairman. I very much appreciate the opportunity to discuss with you today the issues raised by the recent events relating to the U.S. operations of Daiwa Bank and to provide you with our preliminary conclusions on these issues. This matter has troubling implications for supervision and regulation in a world of multinational banking and increasing interrelationships of financial systems. Not only were bank employees able to conceal massive losses over an extended period of time, but senior management of Daiwa also took steps to conceal the events in question from U.S. regulatory authorities. We also understand that some officials at the Japanese Ministry of Finance were informed in early August about Daiwa's losses. They did not instruct Daiwa to inform the U.S. authorities, nor did they themselves do so. This lapse on the part of the Ministry of Finance is regrettable because open communication and close cooperation among supervisory authorities are essential to the maintenance of the integrity of the international financial system. Finance Minister Takamura has acknowledged the Ministry's failure in this regard and has pledged that in the future the Ministry will promptly and appropriately contact U.S. authorities on such matters of U.S. interest. We have been assured that the Ministry is taking steps to implement this pledge. In addition, we have been pleased that once the Daiwa problem was disclosed, the Japanese authorities have fully cooperated with U.S. supervisors in dealing with the consequences. The action of the Federal Reserve and other regulatory authorities to terminate the U.S. operations of Daiwa was stern, but was taken because actions such as Daiwa's carry the threat of significant damage to a major asset of our nation, the integrity of our financial system, as you, Mr. Chairman, have just pointed out. Trust is a principle of central importance to all effective financial systems. Our system is strong and vibrant, in large part because we demand that financial institutions participating in our markets operate with integrity, and that any information made available to depositors and investors be accurate. When confidence in the integrity of a financial institution is shaken, or its commitment to the honest conduct of business is in doubt, public trust erodes and the entire system is weakened. The need to trust other participants is essential in a complex marketplace. For example, on the basis of trust, counterparties typically trade millions of dollars on an oral commitment that may not be formalized for hours. A breach of that trust by failure to honor such commitments, presumably because markets turn adverse, would inevitably lead to an institution being drummed out of the marketplace. There is no set of statutes that can ensure the effective functioning of a market if a critical mass of financial counterparties is deemed untrustworthy. Any risk that counterparties will not honor their obligations will be reflected in a widening of bid-ask spreads, a reduction in liquidity, and as a consequence, a less efficient financial system. Consequently, actions such as I have recounted in the Daiwa case cannot be tolerated. The potential cost to our financial system and hence to our economy is too large. What is true for the financial system in general is particularly true for the supervision of financial institutions. Indeed, the whole system of supervision proceeds upon the basis of trust, whether in terms of the veracity of representations or reports filed by management or transparency with regard to any material developments affecting the financial condition of the institution. This is not to say that supervision can be based solely on trust. Supervisors must test a bank and its management in its compliance with law and sound business practice. An appropriate balance, however, must be struck. Without reliance on trust, an army of permanent resident examiners would be necessary to assure that the operations of a bank are conducted in a manner that is safe and sound and otherwise consistent with the requirements of law. Such an approach to supervision clearly would be counterproductive to the desired support of a vibrant, innovative banking system. For a supervisor to become a bank's internal auditor would either stifle the independence of management in the bank or create an unacceptably adversarial supervisory process. In this context, we have sought to review the examinations in question in an effort to determine whether supervision of Daiwa should have proceeded on a different basis and how problems might be avoided in the future. With the benefit of hindsight, there were some clues that were missed in the examination of Daiwa. We accepted the statements by Daiwa management that the internal control problems identified in our examination had been corrected, including separation of Mr. Iguchi's combined front and back office functions. With a more robust follow-up, the problem might have been found sooner. The examinations were conducted at a time when the Federal Reserve was still in the process of implementing the Foreign Bank Supervision and Enhancement Act of 1991. We have worked diligently to carry out the intent of that statute by developing an improved supervisory program and new rating system for foreign banks, as well as new examination manuals and training schools for examiners. This has been done consistent with the purpose of the 1991 Act to assure that the U.S. banking operations of foreign banks are supervised with the same attention to safety and soundness issues as our domestic banks. Nonetheless, the bottom line is that we did not succeed in unearthing Daiwa's transgressions where we might have. Hopefully, this event will stiffen our resolve. However, even given the new supervisory program and tools as well as our heightened sensitivity to possible red flags, no system of supervision will uncover all fraud. The lesson forcefully taught by this unfortunate case, as well as the catastrophic losses suffered by Barings, is that management must pay as much attention to such seemingly mundane tasks as back-office settlement and internal audit functions are to the more exotic, high-technology front-end trading systems. These recent events also reinforce the need for supervisors to pursue rigorously the expeditious correction of internal control deficiencies in financial institutions. I would like to conclude, Mr. Chairman, by discussing a few general points relating to the supervisory system and its functions within the international banking system that are raised by this case. No supervisory system can nor should endeavor to stop all losses. Any system that attempted to be fail-safe would impose intolerable costs on the public and the banking industry, and almost certainly would stifle legitimate financial innovation. Moreover, in any supervisory regime, the ultimate responsibility for the protection of a privately owned bank must rest with the top management of the bank and its directors. After all, it is in their long-term interest to operate the bank in a safe and sound manner and to obey the law. Supervisors must, to some extent, rely on this mutuality of interest in performing their tasks. An assumption that most bankers are truthful should remain the rule, not the exception. When, however, a bank has shown through repeated actions that it cannot be trusted, even at the highest levels of the corporation, supervisors should resort to extraordinary regulatory measures. In such circumstances, Congress has provided the supervisors with what I believe to be a full and appropriate range of powers. We are considering a number of initiatives that may be implemented at an administrative level, especially with respect to internal and external audit standards. For example, we are presently reviewing our general policy in this area to determine the extent to which more specific guidance can be given to examiners for purposes of evaluating the adequacy of audit coverage. Consideration also will be given to requiring targeted external audits in banking institutions, whether foreign or domestic, where deficiencies in operations or concerns over the adequacy of internal audit have not been addressed. Clearly, we also need to implement fully our enhanced supervisory program in an expeditious manner. In doing so, the Federal Reserve will be reviewing the Daiwa case, Barings, and other major international banking events to identify further specific improvements to the supervisory process as it applies to both foreign and U.S. banks, as well as our existing statutory authority. We will, Mr. Chairman, report to Congress on the conclusions of our review. Thank you very much.
Thank you. Before we proceed to Chairman Helfer, we've been joined by Senator Domenici. Senator Domenici, do you have an opening statement?
I do not, Mr. Chairman. Thank you.
Okay. Chairman Helfer.
Thank you very much, Mr. Chairman, members of the committee. I appreciate the opportunity to testify on the role of the Federal Deposit Insurance Corporation in supervising the segment of foreign bank operations in the United States that has federal deposit insurance, and in particular the Daiwa Bank Trust Company, the only insured U.S. office of the Daiwa Bank Limited. As of June 30th of this year, the FDIC had primary federal supervisory responsibility over 68 insured foreign bank-owned subsidiaries and 35 state-chartered branches. These 103 entities had total assets of approximately $110 billion, or about 10% of total foreign bank assets in the United States. The FDIC shares supervisory responsibility for these entities with the applicable state licensing authority. Mr. Chairman, you have asked us to address the significant problems at the New York branch of Daiwa and at Daiwa Trust. Those problems were of three types. 1, unauthorized trading activities. 2, significant deficiencies in internal controls for monitoring compliance with laws and regulations and risks. And 3, a breach of trust by Daiwa officials involving a long-term conscious effort by senior managers to deceive regulators on losses stemming from trading activities. Simple fraud was compounded by collusion, which made the detection of various fraudulent acts more difficult to discover. Acting together, the Federal Reserve, the New York State Banking Department, and the FDIC, along with supervisory authorities from 5 other states, took very specific action. 1, they concluded that the conduct of Daiwa and Daiwa Trust was highly inappropriate and failed to give assurance that standards of safety and soundness would be met. And 2, that the only suitable response was to terminate Daiwa's privilege to conduct banking business in the United States. Mr. Chairman, my written testimony describes the significant problems at Daiwa and Daiwa Trust. It also describes more generally foreign banking organizations that operate in this country and the FDIC's role in supervising them. It discusses the FDIC's recent actions against Daiwa Trust, and it presents a range of supervisory issues raised by the experience with Daiwa and Daiwa Trust. And it discusses the FDIC's continuing responsibility and responses to these issues. In the interest of time, I will submit that complete testimony for the record. This afternoon, I will emphasize only a few very important points. Point 1. Fraud is difficult to detect if a bank's management is covertly misleading examiners, as was the case in Daiwa and Daiwa Trust. Bank examinations are not designed to identify fraud if there are no signals that misconduct has occurred. Bank examinations are designed to evaluate the overall financial condition of the bank and the adequacy of management. Examinations are conducted to gauge the safety and soundness of an institution, to ascertain the risks it poses to the insurance funds, to evaluate the internal controls for monitoring risks and compliance with the law, and to protect depositors. An examination is based on the books and records of the bank, statements made to the examiner by institution officials, and information obtained from other reliable sources. Like a medical examination, a bank examination is a disciplined look for warning signals. Where warning signals are concealed, examinations may not find significant problems. Despite the fraudulent responses of Daiwa officials to the losses at Daiwa Trust in the mid-1980s, the FDIC's deposit insurance funds will not suffer losses. Point 2. The FDIC has instituted a comprehensive analysis of all of the facts related to the misconduct of Daiwa Trust. As part of that effort, in addition to analyzing the supervisory records of the FDIC and the New York State Banking Department, interviewing the examiners, and reviewing all other relevant materials, the FDIC and the New York Department are currently conducting examinations at Daiwa Trust and are coordinating closely with the Federal Reserve with respect to the significant problems at the New York branch of Daiwa. An outside accounting firm has been retained to perform a comprehensive review of the improper activities at both Daiwa and Daiwa Trust at the direction of the 3 banking agencies. Finally, all of the agencies are cooperating with the ongoing criminal investigation by the Office of the U.S. Attorney for the Southern District of New York. Point 3. Given the Daiwa experience, the FDIC is revisiting its approach to examinations for foreign and domestic institutions, particularly in the trading area, with respect to those institutions over which the FDIC has supervisory responsibility. In response to the issues raised by the Daiwa experience, the FDIC will expand its review of internal and external audit work papers, particularly in regard to direct confirmations of trading activities. Our examiners already review all audit reports. We will tailor our examinations of the internal controls relevant to a bank's trading department to take into account any deficiencies we find during reviews of the audit work papers. In addition, we are focusing more on internal controls in our training and guidance of examiners, continuing an increased emphasis in this area that started in the mid-1980s. In fact, the approach we take to examinations today might have found problems at Daiwa Trust closer to the time when they occurred, had the procedures been in place in the mid-1980s. In particular, we now review comparative reports of condition, or call reports, for significant changes between financial reporting periods. In hindsight, there were sizable increases in holdings of U.S. Treasury bonds between March and June of 1987 in Daiwa Trust, when bank management booked the securities that covered previously unbooked positions stemming from undisclosed trading losses. Current pre-examination planning techniques might well have noted such an increase, triggering expanded attention to the transactions. We are also looking into whether we should develop examination procedures that require some measure of external confirmations of trading activity during our examinations of institutions with active trading departments. Such an enhancement of examination procedures would require the use of additional resources and would add to the burden and time of examination. So we are weighing this course very closely. Mr. Chairman and members of the committee, the ability of any bank, including foreign banks, to operate in the United States is a privilege. All banks, foreign and domestic, are required to meet the same prudential standards. The privilege of doing business here carries with it certain responsibilities. The necessity for accurate, readily understandable books, records, and financial reporting encompassing an institution's operations, activities, and transactions. Internal controls to monitor the level of risk in the institution's operations and its adherence to applicable legal and prudential standards, and management with utmost credibility. Daiwa breached these standards. The actions taken in response by the bank regulatory agencies was therefore completely warranted. In conclusion, Mr. Chairman and members of the committee, the FDIC will continue to work on an interagency basis to implement a comprehensive approach to ensuring effective supervision of foreign bank operations in the United States. In addition, the FDIC, which is a member of the Ball Bank Supervisors Committee, will work with the committee to ensure greater international cooperation and coordination, timelier communications of problems among international regulatory authorities, and more effective supervision of multinational banking organizations. Thank you, and I look forward to your questions.
Thank you, Chairman Helfer. Superintendent Levin.
Thank you. Afternoon, Chairman D'Amato, Senator Bennett, Senator Domenici. Thank you very much for the opportunity to appear before you this afternoon to share some thoughts concerning the recent events surrounding the Daiwa Bank Limited and the issue of the supervision of foreign banks generally. I would ask that the full text of my testimony be included in the record. The revelations with respect to the unauthorized trading activities of Mr. Iguchi and the apparent efforts by senior management at Daiwa to hide these misdeeds from the attention of the bank's lawful regulators once they were discovered are indeed shocking. One's sense of dismay is only heightened by the subsequent disclosure of prior occasions when the bank failed to address in a forthright manner other trading losses incurred at the Daiwa Bank Trust Company. These actions are so disturbing because they fractured the trust which formed the foundation upon which all banking regulatory efforts in this country must be founded, whether the regulator is the New York State Banking Department, our federal counterparts, or the other state regulators, and regardless of whether we are discussing foreign or domestic banking institutions. Clearly, there are some preliminary lessons to be learned concerning the supervision of foreign banks in the United States from what is already known about this incident. I will share some of my observations in that regard in a few moments, but again, I would like to stress that these impressions can be only preliminary. As you no doubt are aware, a criminal investigation initiated by the U.S. Attorney is underway, and therefore we will express or demonstrate some sensitivity with regard to these matters. These reviews and inquiries collectively will provide a much more, In addition to the U.S. Attorney's investigation, the Banking Department is in the midst of its own exhaustive inquiry into this matter. In addition, the accounting firm of Arthur Andersen has been retained to undertake a thorough forensic audit of Daiwa's New York activities pursuant to the cease and desist orders issued against Daiwa's New York branch and the trust company. Arthur Andersen made a similar review in connection with the failure of Barings PLC, and so has invaluable experience to share in helping to unravel what really happened at Daiwa. At the same time, I know that our federal regulatory colleagues are undertaking their own thorough investigations. These reviews and inquiries collectively will provide a much more comprehensive understanding of this troubling episode than is possible to provide today. I believe this is important to keep in mind in attempting to frame appropriate responses to the problems illuminated by the Daiwa incident. Therefore, again, if some of my words seem to be hesitant, it is only because of the sensitivity with regard to ongoing criminal investigations. Having said that, before assessing the performance of foreign bank supervision in the United States, it is critical that there first be agreement as to what goals and objectives the regulators should be striving to achieve. The Banking Department's statutorily prescribed mission is to maintain the safety and soundness of the institutions it oversees, maintain public confidence in the banking system generally, and protect the public interest. Regulators in the United States traditionally have addressed the issue of safety and soundness by focusing on whether a bank possesses sufficient reserves to absorb potential losses and whether there are in place adequate procedures and rules to deter imprudent activities that might threaten the bank's stability. Historically, bank regulators have not attempted to verify the accuracy of individual transactions in order to detect fraud. That responsibility has been ascribed to the bank's internal and external auditors. The truth of the matter is that it always will be difficult to guard against those who wish to subvert the banking oversight process by engaging in a conscious, concerted pattern of fraud, lies, obfuscation, and indirection in their dealing with their regulators. I return then to the concept of trust. The successful supervision of banking institutions requires an environment of absolute frankness and total candor between the regulator and the institutions being regulated. Anything less is unacceptable. If one may say that anything good has come from the Daiwa incident, it is that the banking regulators in this country have spoken with one voice in stating unequivocally that behavior such as that which has come to light at Daiwa will not be tolerated. Commentators publicly speculated that Daiwa might face stiff fines in connection with this incident, but that the withdrawal of Daiwa's several operating licenses was unlikely and was even dismissed by some as a draconian measure. They were wrong. They were wrong because they failed to appreciate the fundamental relationship between the trust mechanism and the proper regulation of banking institutions. They were wrong because they failed to recognize the importance to the United States of maintaining the integrity of its banking sector and capital markets. Was the reaction of the Banking Department and the federal and other state regulators draconian? Not at all. In my view, it was the proper and measured response to a frontal assault on the bank supervisory process. When a bank conducts unlawful activities and management attempts to hide such activities from the bank's regulators, the rules of conduct underlying the banking business are broken and the system is undermined. It is well to remember that the decision to withdraw Daiwa's licenses is not a reaction to a single incident. Rather, it addressed a chronic pattern of deception occurring over a number of years and involving the bank's most senior officers. The response of the collective regulators of Daiwa was unambiguous and is illustrative to those who may be tempted to do likewise. In the final analysis, perhaps the greatest single resource available to the regulator is the resoluteness of conviction to insist that the banking institutions it oversees maintain complete fidelity to this trust mechanism and to deal swiftly and harshly with those who do not. The challenge is to marshal and deploy the supervisory tools available in a manner that retards the development of problems like Daiwa in the first place. With the advantage of perfect hindsight, one must conclude that regulators can and must do a better job in this area. Therefore, I do have several initiatives to share as a preliminary response to some of the issues raised by this matter and which I have decided to implement in New York State at the earliest practicable date. The first will be the imposition of a mandatory external audit requirement for each foreign branch or agency in certain prescribed instances, such as where they might result in improved financial controls and systems generally at an institution, or where breaches in internal control functions have been discovered. This requirement may include an annual audit in some of these circumstances. Second, the Department will set out guidelines banks can use to establish internal policies governing the review of problems once they are detected. These standards should provide guidance as to when investigations can be handled by internal staff and when third-party professionals should be engaged. I am also considering whether it may be appropriate to require each foreign bank to engage an independent auditing firm to assess the internal control structure and compliance with laws and regulations relating to safety and soundness. Third will be a requirement that all banks, foreign and domestic, implement firm vacation policies to require that employees occupying sensitive positions be off-site and offline for a minimum period of 10 consecutive business days each year. This will make it harder for such persons to cover up fraudulent or otherwise improper activities. Along with these measures, the Banking Department will stress to all of the banks it oversees the need for prompt and candid notice to the Department as soon as problems are discovered. At the same time, the banks and the Department's own personnel both will be put on notice that in the future, better follow-up will be required in order to monitor the resolution of identified weaknesses at banks, even if they do not rise to the level of supervisory action. Finally, the Daiwa incident highlights one other important aspect of foreign bank supervision that I wish to touch upon briefly, and that is the continued vigor of the dual banking system. The interplay between the federal and state regulatory structures provides a healthy tension in the administration of the supervisory function at both levels. In the past several years, there has been an accelerating trend towards the coordination of activities between the Department and its federal counterparts in an effort to create a regulatory synergy, drawing upon each regulator's strengths. The focus of all regulators in striving for greater cooperation must be the quality of supervision. Certainly, the unified response of federal and state regulators to Daiwa is evidence of the close cooperation that presently exists. It is testimony to the strides being made in coordinating the execution of regular duties, such as conducting an increasing number of joint and concurrent examinations, that the regulators were able, in short order, to present a seamless response to a crisis of Daiwa's magnitude. Turning now to the particulars of the Daiwa matter, it is important to consider several factors in attempting to understand why Mr. Gucci's trading losses remained undetected for so many years. At any given point during this period, there were different issues that dominated the concerns of regulators, and the Banking Department deployed its resources in order to best address these priorities. One also should bear in mind that Mr. Gucci devised, either alone or with others, an elaborate system deliberately designed to escape detection. Finally, as was previously noted, bank examinations are not and never have been designed or intended to ferret out fraud. Instead, the Department quite properly focused its attention on Daiwa's fundamental safety and soundness. Put most simply, the Banking Department did not scrutinize Mr. Gucci's Treasury bond trading activity per se, because his responsibilities as a trader, a supervisor of traders, and as head of Daiwa's custody area were obfuscated. In retrospect, however, the Banking Department's scrutiny of this matter, once it was apprised of the true nature of his activities, was inadequate. As I stated earlier, in the future, the Department will need to be more aggressive in its follow-up concerning such matters. In any event, the bank moved most of its operations to Midtown Manhattan in 1986, at which time the Department understood that the downtown office would house the custody operation only and serve as its back office. The Banking Department learned during the 1993 joint examination with the Federal Reserve Bank of New York that Daiwa had misrepresented that its trading operations were conducted only in Midtown. The ostensible reason for this subterfuge was that the Japanese Ministry of Finance had not given approval for Daiwa to have traders downtown after 1986, and Daiwa did not want the Ministry of Finance to learn the truth. Before that time, the Banking Department had no reason to believe that its examinations of the trading operations in Midtown were not comprehensive. As regards the losses incurred by Daiwa Trust, these were not reflected in the financial statements prepared at that time, nor was the banking department notified until October 5, 1995, as to their existence by either the bank or Daiwa Trust. As has been publicly reported, there were several oblique references to the matter contained in the confession of Mr. Gucci, and this prompted regulators to include references to possible trading losses at the trust company in the October 2nd cease and desist order. As I have indicated, the Daiwa book has yet to be written in its final form. The banking department shares the committee's concerns regarding this incident and the questions raised with respect to the regulation and supervision of foreign banks. The initiatives I have outlined represent a measured preliminary response to these issues. Foreign banks are an integral part of the economic fabric of New York State and our nation. The banking department was the first regulator of foreign banks in the United States and remains the primary regulator and chartering authority of branches and agencies of foreign banks, representing approximately 72% of the total foreign branch and agency assets in this country. The department seeks to foster their continued safe and sound participation in the financial system in an operating environment that promotes open lines of communication between such banks and their regulators. I have attempted to summarize for you some of the main items which are treated in greater detail in my full testimony and would be happy to respond to any questions. Thank you.
Thank you, Mr. Levin. Let me ask all of you whether or not you believe that some of the shortcomings that have been testified to, for example, the failure to supervise Mr. Iguchi, the fact that he never took a vacation, the fact that here he was making these trades and then he was the person who was recording these trades. That's an absolute breach. That is something that is not permitted. The person who makes the trades does not then have supervision to record. What, if anything, are we doing to ascertain what level of cooperation or adherence to U.S. laws is taking place with other foreign institutions? Do you believe that's a problem with other institutions, or that there may be?
Mr. Chairman, I think that the first thing that we are all aware of, and indeed take it as a cardinal primary rule of supervision and regulation, is that we cannot and should not be a substitute for the internal auditing processes of a bank. The primary responsibility of necessity, as I indicated in my prepared remarks, is with the management and the board of directors, because the losses that are immediately obvious are clearly to the shareholders of those institutions. Nonetheless, we cannot assume and do not assume that we are getting at all times perfectly adequate internal auditing, or to the extent that it is relevant, the bringing in of external auditors to effectively create for the supervisors a body of data and information which we can assume is wholly accurate. On the other hand, we know that if we are involved with issues of embezzlement or various different types of fraud which are not picked up by the internal audit system, it is exceptionally unlikely that we will be able ourselves to pick it up. What is important for us to do is to make certain that the process, the internal consistency of the control mechanism within these institutions can effectually pick up these types of egregious events. Having said that, Mr. Chairman, it is a fact that when we all looked at the international operations of a number of institutions, our initial response was to recognize that there are cultures which are different from ours, and as a result we saw a number of anomalies throughout the branches and agencies of foreign banking institutions, which we have moved very aggressively, as best I can judge, to try to redress. I don't think we're there yet. I don't think we'll be there for a while. It's an extended process, and I would not say to you that I do not know that there are not other problems with other institutions. I do say to you that we have mobilized very considerable resources to make sure that that is unlikely to be the case. And I would suspect that my colleagues here will attest to the fact that the amount of efforts we've all brought to bear since the 1991 Act have really been quite extraordinary in that regard.
I would add, as an addendum to Chairman Greenspan's comments, that the Federal Deposit Insurance Corporation Improvement Act required external independent audits for institutions with $500 million in assets or more that were insured institutions. And that is 92.3% or so of foreign banks with insured offices in the United States are required to meet those requirements and do. That is an important development. It is, of course, true that in the case of this institution, there were external audits, and to date we have no reason to believe those external audits were any more effective than our examiners were in finding the problems in the two institutions. That is back to the issue, unfortunately, of fraud. However hard we try, and the FDIC has 40 nationwide fraud specialists that are brought into examinations whenever fraud is suspected. But if there is no signal, no warning flag, it will be difficult to detect fraud, and certainly, unfortunately, was in this case.
Let me ask you, after the 1993 report during the examination by the Fed, it was reported that for the first time you were informed, the Fed was informed, that indeed DIWA had misled and had lied to the Fed in terms of its Midtown operation. And it even disguised the trading area to look like a storeroom. After the Fed, and I don't know if the FDIC also learned about this, what corrective action was taken? And then I have to raise the question, isn't lying, intentionally lying, a criminal violation?
That was a difficult issue for regulators because it was clear that that transgression did not in any way that anyone could figure out undermine the quality of the examinations that were had taken place earlier, so that we could not readily say that that deception had created a problem for us. Nonetheless, there was, as I understand it, extensive discussions as to whether or not certain specific supervisory action should be taken against the institution as a consequence of that. At the end of the day, it was decided not. One of the reasons was that significant other areas of exploration had unearthed questions of internal controls and certain asset quality issues, as indeed all banks had at that time, which took a good deal of our attention. In retrospect, I think that whenever you realize that an institution says one thing that is clearly untruthful, the probability that there are more should have been a signal to us to examine further. At the end of the day, we did not, and I think in retrospect that was a mistake.
Mr. Chairman, let me not mince words, but let me ask you something that's very troubling to me. If this had been a major U.S. banking institution, take any number of them, I'm not going to name any one, and they had lied to the examiners in a similar situation, and it was found out that they had lied, would there have been any hesitancy to take a very, very strict action against them? I mean, at the least, this is a violation of U.S. law 18 U.S. 1001. I don't know whether or not your examiners would have referred this to a criminal referral, but certainly it seems to me that they would have taken some very tough remedial action, wouldn't they? And the reason I ask that is because, was it because Daiwa is a foreign bank, a Japanese bank, that they were permitted to get away with this, as opposed to really being leveled right then? I mean, this was this was not just an incidental matter, a matter of losing something in translation, a matter where you could say it's a cultural. They absolutely lied to the examiners and told them they weren't conducting trading. They disguised the whole floor. They went through this elaborate process. And then, so now I'm saying, if this had been any large U.S. institution, do you see a similar treatment, or would they have come down? Would you have come down on them pretty hard?
Mr. Chairman, I can't answer that because that is an issue of discretionary policy on the part of our supervisory staffs in conjunction with our legal staff. I do know.
Well, you know we're going to get to that. I mean, I have to tell you, I will withhold at some point in time in deference to the U.S. Attorney as it relates to various individuals. But make no mistake about it, that notwithstanding the deep respect that this committee has for you and your colleagues, that we will, it is absolutely essential for us to ascertain how it was that something that was so serious was not acted upon, and that indeed what actions were taken, if any.
Mr. Chairman, I can say two things. One, that issue was very thoroughly vetted, and the conclusions were legal conclusions which I don't have the capability of commenting upon. More importantly, however, I can assure you that I know of none, and indeed I'm certain that there are no differences between the way we examine international banks, foreign affiliated institutions, and domestic institutions. The processes are the same, the standards are the same. The only differences that exist are basically that the unique nature of certain institutions require us to do technically different things in the examination, but that in no way would it either enhance or degrade the status of a foreign institution relative to a domestic one.
Again, I am troubled by this, and as you've indicated, you feel also that maybe a different course of action should have been taken. It wasn't, unfortunately. Certainly we can say at least we did not lose taxpayers' money at this point. Let me, before I yield to Senator Bennett, ask one question to Chairman Helfer. Apparently the FDIC did not detect some $97 million in losses incurred by Daiwa back in the mid-'80s. Are you aware of that particular aspect?
Yes, I am. Daiwa Trust was the responsibility of the FDIC because it was the only insured office of Daiwa in the United States. Between 1984 and 1987, Daiwa officials have acknowledged some $97 million in net trading losses, some of them through trading that was unauthorized during that 3-year period.
How did it come to use the Cayman Islands, if you, in your explanation, I'd like, if you know, to conceal these losses?
We have been informed by Daiwa officials that offices in the Cayman Islands were used as a basis for concealing the losses. That particular issue is now the subject of a criminal investigation, and we have been asked, Mr. Chairman, to withhold comment on any information we may have with respect to specifically how Daiwa's losses may have occurred.
I understand that. Let me ask you this. Are you aware of the names of those employees who caused those losses?
I have read the names of those employees in various accounts.
Do you know, do you have any information as to what has taken place? Are they still employed by Daiwa?
I don't have that information, Mr. Chairman.
Will you look into that?
I'd be happy to give you that information.
Because I'm concerned where the employees returned to Japan, were they given different jobs at the home office? Are they going to be retained there? Are they going to be rewarded there? What, if anything, is going to take place?
We'll be happy to look into that issue, Mr.
I
Chairman.
think. Senator Bennett?
Thank you, Mr. Chairman. I find this whole experience a little hard to credit. That's always easy to do in hindsight. When you're going through it or looking forward, it's always tougher to find it out. But now that we have the chronology in front of us, Mr. Gucci began losing money at Daiwa in trading in 1983. By 1988, his losses were over $200 million. 1989, he says he and two other traders lose another $350 million. Total losses then are exceeding $575 million. And yet it's not until 1995 that it finally comes out. The losses started small. They continued for a large number of years. That means the problem didn't just suddenly arise, that someone, I won't try to get into the issues that will be discussed in court, someone developed a deliberate pattern of concealing those losses and kept it in place successfully for years and years. And that's the thing that I find difficult to credit, for all of the reasons that you've mentioned in your testimony. I find it astounding that officials of a bank as big and as credible and as reputable as Daiwa would be involved in such a scheme for such a long period of time. And as the losses got bigger, the scheme had to become more and more elaborate. It's easy to conceal $50,000, which is what I understand Mr. Gucci's first losses were in 1983. But $1 billion is a lot of money to hide, and even for budgets. All right. Is there a lesson to be learned here about patterns? And do you feel that the steps you're talking about are sufficient to start looking into those patterns? And as you're contemplating that, which I'd like you to respond to, the comment that Chairman Greenspan made, that he couldn't assure us that there weren't some more of these out there, is in the chairman's usual position of candor and openness, but also a little chilling. So could you address those two issues for us for a minute? The question of patterns of behavior and what we should be looking for over a period of time, and the question of what might still be there. Anyone like to address
Actually,
those
why
two?
don't I give you two a rest here. Going back to something that Chairman Greenspan touched on a minute or two ago, was the focus and the importance of making sure that there are adequate internal controls in all of these foreign institutions. Clearly, since the Daiwa incident was disclosed, the entire regulatory community's sensitivity has been raised with regard to monitoring and measuring whether internal controls are adequate. I think part of the process going on now is to review what we have in place. I think that goes to your question as to what else is lurking out there. Step one is to find out whether a weak internal control environment exists. Step two is, if it does, to scratch beneath the surface to see if anything is there. But again, that process is going on right now. I think in terms of the future, you ask what we can do to safeguard in the future. I think this comes back to something that I alluded to and something that Chairman Greenspan said, which is on a targeted basis, it may be necessary to require some of these foreign branches and agencies to have an external auditor come in on an annual basis. Clearly, our responsibility is to ensure that the control environment is adequate based on some combination of having a controller, having a competent internal auditor, having policies and procedures in place, and in some cases being supported by an independent external auditor.
Senator Bennett, I might just add, as I know you're a longtime student of banking regulation, I have talked to many of the examiners on the DIWA trust exams. DIWA, the FDIC did not have examination responsibility over the branch, so I can't speak specifically to the Iguchi losses, but obviously there were losses in the trust company. And what I was told was many years ago, bank examiners actually did something much closer to an audit. They would go even to the point of counting the cash in the till in the bank before they walked out of the bank to be sure that every single dollar was accounted for. Over time, it was recognized that that probably gave a level of security that might not have been wholly appropriate. And moreover, as there were more and more banks in the United States and bigger banks, it became a very difficult thing or an impossible thing for examiners to do. So banking regulation evolved into focusing on assuring that the institution itself was taking responsibility for the conduct of its operations in keeping with certain prudential standards. As Chairman Greenspan has said, that in the end is the best way to assure the effectiveness of the marketplace. I might also add, fraud is the worst way to assure the effectiveness of the marketplace, and we are now dealing with a fraudulent situation. With respect to the facts of this case, Chairman D'Amato has pointed to two very specific internal control deficiencies, which I believe examiners in both of the institutions should have followed up on more effectively. And those are with respect to the separation of settlement and trading functions, as well as the separation of custodial functions from trading functions, and moreover assuring that that age-old examiner rule that employees ought to be away from the bank for 10 straight business days so that if the employee was engaged in fraud, you might have a chance at finding it, that be enforced. And that was enforced years ago. And then over the years, examiners were willing to accept alternative internal controls to that one, and it turns out that that old rule wasn't a bad rule after all.
Knowing what I know about the culture in Japan, a 10-day vacation is not something anybody wants to take. They somehow feel like their promotion is tied to their showing up in advance of the appropriate opening hour and staying beyond the closing hour to thereby prove their loyalty to the job. And to be told you have to take 10 days and it has to be serious, for many Japanese will be a signal, gee, my job's in trouble. They want me out of here for 10 days.
Just get another job.
Yeah. If I understand, coming back to your comment and Chairman Greenspan's comment, the loss really was shareholders, was it not? Depositors didn't lose any money.
Depositors, there are only about 18% of the deposits in the trust company were insured deposits. The institution is well capitalized. There are no losses, there have been no losses, and there is no expectation of loss. And one of the reasons that we all wanted an orderly resolution of DIWA's operations in this country and provided 90 days for that purpose was to assure that there would not be losses, either to depositors or to creditors.
So if we're getting to this issue of trust that you have spoken so eloquently and accurately about, the management really was defrauding their own shareholders by covering these losses and therefore violating the fiduciary trust they held as the representatives of the shareholders whose money they were entrusted with. Is that the correct example of what's happening here?
I think that is exactly right, Senator, and I think it is especially the case in Japan where the issue of trust and the issue of one's integrity with respect to an institution for whom you work is held in such high regard. I think this incident has come as much of a shock, if not more, to our Japanese colleagues as it has to us.
You compared it, Chairman Greenspan, with the Bering situation, where, again, management really was defrauding their own shareholders by covering these losses. And your talk, Chairwoman Helfer, about the institution itself triggered a conversation I had with somebody about the Bering circumstance, where a currency trader told me, someone called him and said, he called his home office in Switzerland. He was operating out of New York, and he said, in response to the Bering thing, if I were to call you and ask you for a check for $500 million to cover a margin call, would you give it to me? And the answer was, absolutely. I would hand deliver it, which means I would be in your office myself, along with the check, wanting to know what in the world you were doing. And they could not, management in London could not say this rogue trader did it by himself, because they had to provide the money to cover his margin calls. And we have the same pattern here, where Daiwa cannot say Iguchi did it himself, because they had to involve in this pattern of deception over years to cover what was happening and thereby defraud their own investors. So I hear what you're saying in your testimony, that these people really are defrauding their own investors, not necessarily the public, as they engage in these kinds of things. And you have done your job in protecting the public, or depositors in this case. You've just been conned, if we can use the phrase, in a way that was devised to damage, ultimately, the investors. And to the chairman's comment about U.S. banks, I think people invest in U.S. banks because of you and their sense that you will protect not only the depositors, but your procedures will protect the safety and soundness of the institution and therefore the viability of the investor. In this case, the investors were primarily foreign nationals and thereby beyond the reach of your protection. I have nothing really to add to this conversation except these observations. But I appreciate you coming here. And Mr. Chairman, again, I appreciate you calling the hearing, because I think for most Americans that's the bottom line. Not only do they want to be sure that the money they put in an institution will be protected, Ms. Helfer's primary responsibility, but that the institution itself will survive if they were to invest in its shares. And that's the responsibility all of you share. Thank you, Mr. Chairman.
Thank you, Senator Bennett. Senator Domenici.
Well, Mr. Chairman and witnesses, I came today because I don't have anything to do. We're not going to be doing anything until tomorrow, and I thought it might be a luxury to join this committee for a little while. And I thought it would be full, so I would have been sitting down there, but I'm very pleased to be here having a chance to talk to you a little bit. Actually, I didn't come today to talk about the issues that are before us, although I'm intrigued and will have a couple of questions. I came today to, because you are present, Mr. Greenspan, and I regret that in this first round of questions, I don't have anything for either of you, unless you want to comment on how important a balanced budget is to the future of our country, in which event we will welcome.
7 years is the appropriate
Thank you very much.
And the CBO should determine that. Isn't that right, Mr. Levin?
That's right, CBO numbers.
Thank you.
All right. Well, you're pretty much on the ball. Chairman Greenspan, might I first say I have not had a chance in the last 5 or 6 months to attend a hearing in your presence. You've appeared before a number of committees in our body, and I was not on this committee until recently, so I did not have a chance to say a few words to you in behalf of this senator as it pertains to the policies of the Federal Reserve Board, which you chair. I want to commend you and those who are with you on that board. If I had to pick the most significant policymakers that have affected in a positive way the economy of the United States over the last 18 months, I would, without equivocation, say the Federal Reserve Board has had more to do with the solidness of the American economy than any of us, more than the President, more than the Congress. And I know you don't like to hear that, because essentially you would like us to have more to say about it with our fiscal policy. But since we've been out, you know, we've sort of been out to lunch, we've left it with you all, and you've done a magnificent job. In fact, I think perhaps you all have something to write about when this cycle finally ends, this cycle of growth finally ends. I think there will be some very, very in-depth analysis of the very, very excellent manner in which you have maintained this economy growing. Some would like it to spurt much higher, and you will have another story to tell. You will have a story of prolonged GDP growth versus a spurt that might last much, much less than this one has. And you will be able to even quantify that, I'm sure. You can go back in history and say, how much would we have benefited as a people if we'd let a recession occur a year sooner, or have less growth for more prolonged time. So I commend you for that. Your policies, your short-term interest management, which you claim is not a great tool, has been very, very effective. Now, having said that, Mr. Greenspan, a few months have passed since you have testified, not a few months, just a little over a month and a couple of weeks, but you made the following statement on September 22nd. Budget deliberations will be contentious and the deadlines now are extraordinarily tight, but these pressures must not be allowed to prevent us from taking concrete action to implement a program of credible multi-year deficit reduction, close quote. Another quote, failure to take such action would signal that the United States is not capable of putting its fiscal house in order with adverse and serious consequences for the financial markets and long-term economic growth. Do you still agree with that statement?
I do, Senator, and let me just say parenthetically that my colleagues and I very much appreciate your comments.
Would you care to elaborate, not lengthy, but on the adverse and serious consequences for financial markets and long-term economic growth?
Well, Senator, I think the issue really lies at root at the question of how much of the decline in long-term interest rates that has occurred over the past year is attributable to the market's expectation that a credible, important reduction, indeed a balanced budget, is achieved as a consequence of these negotiations. I think over the years it's been fairly obvious that there has been a very deep-seated skepticism in the financial markets that this government had the capability of coming to grips with a chronically disabling budget deficit. Nonetheless, grudgingly, it's clearly done that. And I have no idea what the actual proportion of the 2 percentage point decline in long-term interest rates is attributable to that expectation, but it is a significant part of it. Consequently, if there is a shattering of expectation that leads to the conclusion that there is indeed an incapability on the part of our government to ultimately redress the corrosive forces of deficit, I think the reaction could be quite negative. And I'm fearful that were that to happen, that is, a sharp increase in long-term interest rates, which would be the reversal of the process which discounted the culmination of these budget hearings in a successful manner, then I think we would find that with mortgage interest rates higher and other related rates moving up, interest-sensitive areas of the economy would begin to run into trouble. And that is a view I held when I testified before this body last, and I see nothing to change a word of that testimony.
Mr. Greenspan, one last question. You used the word various times, credible multi-year. Is it fair to assume that credible has many connotations and many realities, but might I mention two and see if you agree? Would it be fair to assume that looking at the United States budget as it currently is structured, that credibility depends upon savings that will occur because entitlement programs are changed to cost less, is one aspect of credibility?
Senator, I have argued, and indeed I think I've made presentations over the years, that the issue of entitlements is something which, when you project into the 21st century, creates very obvious problems, because deficits that emerge as a consequence wholly of the aging of the population are really very pronounced. And while unquestionably it is difficult to project budgets into a period 10, 15, 20 years out, when you are dealing with demography, the capability of doing that is really quite impressive. And as a consequence, at some point, as I've argued many times in the past, the issue of the rise in commitments in a number of entitlement programs, which are increasing at a rate in excess of the growth of the tax base, must be reined in, because you cannot continue indefinitely into the future an outlay program which has embodied in it a rate of increase which exceeds the underlying tax base of the economy. And what that means, as I've said before, is that you cannot resolve it from the tax side over the long run, and it ultimately means that one must address the outlay side of the budget in order to gain stability, which is so essential for the long-term growth and prosperity of this economy.
Might just add parenthetically, it seems like balanced budgets as commitments are growing in the industrialized nations. I've just read about the commitment of our big competitors like Germany. They've decided to balance their budget in much shorter than 7 years, incidentally. I believe they've committed in 3 years. France is, at least one of their preeminent leaders has said they ought to balance theirs in 2 years. Just parenthetically, it seems to me all of this is not done based upon some philosophy, but rather based upon something that they are worried about in terms of their people and their people's future. Now, I don't care to have you comment on that because you have heretofore. I would ask you some questions now, too, about the issue before us, if you don't mind, any of the three of you, but I'll offer them to you. Senator Bennett made the point that in this case, this banking system was robbing from its equity holders, the shareholders. Now, essentially, is it not true that you could have a similar scheme of fraud and you would be robbing from from those who had savings on deposit as compared with just equity holders? That could have been the case, could it not? It just so happened in this case it wasn't. But could it not be the case, both foreign and domestic, that we would be robbing from the depositors for this kind of scheme? It could be.
It's certainly possible that depositors can be affected, and unfortunately we had experience during the S&L crisis and
Sure.
the 10 years of bank failures where at least some of the losses to the insurance funds were losses attributable to fraudulent activity.
Yeah. Now, don't let me get by with assumptions if I'm just pushing them on you and they are not true. But it would seem to me that unless there's some process or procedure which is more apt to catch fraud against the use of depository assets, deposit assets as compared with equity assets, that indeed we could have a different situation, and the United States could be in a similar situation with reference to a domestic bank, and we could be causing the federal government to lose money in a fraudulent scheme because we guarantee the depositors. And And I assume there could be a situation where one of our banks had this kind of problem, and it would be the taxpayers' money backing up the guaranteed deposits. Is that not correct? Ms. Halpern?
It is certainly possible that, as I've said, we have, unfortunately, have some historical precedents which suggest that fraud can be a basis for losses to an institution that can lead to losses in the insurance funds, and in the case of the S&L crisis, as you point out, ultimately to the taxpayer. And I would agree, I think, with the implication of your question, which is merely saying this is fraud and fraud is hard to catch isn't enough. And we all would agree, I think all of us have indicated in our testimony that we are looking very closely at ways of enhancing our examinations while balancing the burden of examinations, which we do try to do, in healthy institutions which are obviously not guilty of fraudulent conduct.
Yeah.
And that's essentially, I think, what our goal is. We have to look more effectively at the red flags I talked about, which lead to more intensive examination procedures.
But my point is this. I believe I've heard here, and I didn't catch all of Dr. Greenspan's testimony, but my staff has told me that the testimony seems to be saying that since 1992, when we changed the law to add a additional ingredient of supervision and some personnel assets to do that with reference to foreign banks, it would seem to me that one could and you have further said that they are subject to exactly the same supervision as an American bank, have you not? So it would seem to me this is not a Japanese issue, but an American issue. Because if this could happen to a Japanese bank doing business here, clearly it could happen to an American bank doing business here. Is that not correct?
That is correct, Senator.
So it becomes very, very important that we find out what else can be done with reference to this kind of activity as it might affect American banks. Our chairman is quite and properly concerned about whether the supervision of this bank, since it is Japanese, was handled correctly by the Japanese. But I think we also, as we proceed through this, have to inquire about American banks in the process. So let me ask, am I right in assuming that since the adoption of the changes in 1992, I'm trying to get the name of that statute. What was the name of it?
Foreign Bank Supervision Enhancement Act, which
Thank
was
you.
in 1991. It was Title II of FDICIA.
All right, thank you very much. Are we fully implementing that now with reference to foreign banks? I ask either you or Dr. Greenspan.
I think I'll defer to Chairman Greenspan, since the Federal Reserve was given most of the authority under that legislative change.
And they were the prime agency requesting that change, were they not? Wasn't Dr. Greenspan the one who advocated it? That's what my notes say. Is that correct?
That's correct.
All right, is it being implemented?
And one of the major technical resources that we had in order to understand the process is sitting to my right.
When I worked for him at the Federal Reserve.
Okay. Gotcha. Well, you both could answer it quickly. I know I'm using too much time.
Yes, Senator, I think the changes that were implicit in the Act were really quite extensive in the sense that they required a very significant increase in resources. And indeed, the number of supervisors that were required to be put on at the Federal Reserve Bank of New York and at the other Federal Reserve banks where there is large foreign presence is really quite extraordinary. And I don't think we are yet to the point where I myself feel comfortable that we've digested that process. We still have a great deal to learn. There's still a great deal of work to be done, and I think I tried to outline in my prepared remarks a number of the things that we are doing. I should also assume that at some point we would be able to flatten out the commitment of resources as we finally get to a position where we feel comfortable. Regrettably, there's no way to do a change of this nature through transition. It comes abruptly, but the mechanism which we have to adjust to it cannot be abrupt. We have to hire people, train them, gain the experiences that they have. And remember, it occurred in a period when losses were really quite extensive in this country in real estate and other things. and therefore a great deal of the efforts on the part of the newly hired examiners was to look at asset quality, look at credit risk, look at the standard types of things which resolve around safety and soundness, which is the crucial issue which we have to address. As a consequence of that, my own judgment is that we probably allowed some of the secondary but increasingly now obviously more important questions not to be addressed as efficaciously as I think we should have.
Thank you. Thank you, Mr. Chairman, for allowing me extra time.
Thank you, Senator. I think you made a number of points. I think one thing is absolutely clear from DIWA, and that is that there must be much more aggressive follow-up whenever a problem is discovered in the bank. Will all three regulators agree with respect to that?
Absolutely.
I think, I referenced this in my testimony, I think that if there is a weakness in the current system of supervision, it is related to weaknesses which are identified in an examination but don't rise to the level of any type of enforcement action or supervisory action. I think we at the banking department need to figure out ways to be more aggressive in following up those issues.
Let me say, I am deeply troubled by the lack of cooperation. Chairman Greenspan alluded to the fact that the Japanese Ministry of Finance has had some contact with you and indicated they understand that. But I think the Finance Ministry was informed about DIWA's problems on August 8th, but they didn't notify any American banking authorities for a full 6 weeks. We're 6 weeks later. I'm not going to say that certainly that is a breach of any kind of agreement of cooperative nature and is absolutely thumbing its nose at us. I'm going to ask the Chairman, what, if anything, did they communicate to you was the reason for this? And how do they intend to deal with this in the future? What assurances can you give this committee that they're going to undertake? Because they have to understand we are not happy with this kind of activity, which is, it seems to me, they're just saying we don't care what your laws are. We're going to do what we think is in our best interest. That's an attitude that I don't believe that we can tolerate. So I don't lay this at you, but I'm wondering what was their response to you, Mr. Chairman? Do they understand that we're not just going to indulge them?
I think they understand the issue far more now than they did at the time. As I understand what the nature of the problem was, is that it is the convention, or has been, I should say, of the Japanese banking authorities, when confronted with an internal problem of the bank, to basically address it, make sure the nature of it, and go through an examination before it becomes a public issue for fear of the potential consequences that might have externally on the reputation and perception of the institution itself. I think in retrospect that the Japanese authorities are recognizing that that is a particular policy which, in the broadening scope of international bank cooperation, doesn't work terribly well. I think they point out quite correctly that the Basel Concordat, which essentially indicated the form of cooperation which should exist amongst international banking authorities, is not a statutory one, but is one of a general agreement. I think that while they state correctly that while they may not have actually been in actually violated the actual fundamental concordat as such, certainly the spirit of what that particular agreement was in fact violated. I think they understand that, and in my judgment, according to what I have had communicated to me by a number of my colleagues in Japan, is that I think that they realize that the old system doesn't work as well as it did, and that fundamental changes, I think, are in process. And indeed, the Ministry of Finance has announced those publicly.
Mr. Chairman, let me say this. All three have indicated that there was a lack of the kind of follow-up that could have done more to detect this earlier. I understand that. These things happen. And again, there is no guarantee against fraud or the rogue. We can attempt to devise the best system, but if someone is going to set out to do this, why, it's going to be pretty difficult. At some point in time, they will be detected. I think that the very disturbing thing to this, at least to me, and I know Senator Bennett and Senator Domenici share this, is the fact that officials high up in the bank obviously learned about this for a number of years and became part and parcel of concealing these losses and went along with it for whatever reason. Maybe they thought he'd make a profit someday. I mean, that's a pretty tough employee to have on the payroll, paying about $100 million a year since he started this.
You mean expensive?
A rather expensive employee. But they made that determination. I think your determination as it related to revoking their charter or ability to do business was the correct message to send. I'm not suggesting to you that I'm entirely happy with that. If they are simply allowed now to be purchased by another institution and continue and their business over here is picked up by someone else, I have to, and maybe at some point in time you can explain to me how that's going to operate. But is it just merely throwing their business over to somebody else, one of their buddies? They're going to continue? I just bring that forth to you because that I would find distressing. I don't know if you envision any other plans with respect to any other fines or penalties that may be assessed aside from the matter which is presently in the courts as it relates to the federal jurisdiction. Are you contemplating any additional actions as it relates in the nature of a penalty?
Until the U.S. Attorney's case is brought and completed, I think it would be inappropriate for us to do or to address any other potential actions we may or may not take.
Well, okay. Well, I will accept that for now. However, I want to leave you with the admonition that I don't think you're simply revoking their business charter, the ability for them to do business is sufficient, notwithstanding whatever the criminal action turns out to be. I just leave you with that feeling. That then sends a message that you come here, that you break the law, and that's why I got to Mrs. Helfer, and I respect the Chairman Helfer's request, answer to my question as it relates to these traders who back in '83, or bank officials who back in '83 were detected undertaking this fraud of some $90+ million, $97 million, I think it was. Is that what you? Yeah. $97 million. What happened to them? And I've asked you to ascertain. Yes. Are they still employed by the bank? Did they get promotions by the bank? Are they back? Where are they? I think that's important because I just don't think, and again, I have to say this, if this was a U.S. institution, I would expect that there would be some very, very tough sanctions against them, even more than just saying, well, now you have to dispose of your business. You can no longer. They'll sell that out over here in the United States. They'll continue their business, and they're going to have somebody else pick it up. I want to know what, if anything, we're going to do to pursue this. I will accept your answer now, but I ask you to recognize we will definitely, as far as I'm concerned, come back to visit this. One last thing, and Senator Domenici might have something. As it relates to cooperation between the Fed and the various state institutions, in this case the New York State Banking Institution, the Fed was notified about the losses on September 18th, and it was 4 days thereafter, before the New York Fed notified the state banking people, New York State banking people. I would hope that this is not a pattern, Mr. Chairman, and that a delay in communication with the state, and I understand the extraordinary nature, but should not have taken place.
No, I agree with you, Mr. Chairman, and if it hasn't been done previously, I would express our apologies to the superintendent.
All right. And I take it that you'll work to see to it that there is a better linkage and communication that flows both ways, from the state to the Fed and vice versa. Okay. Senator Domenici?
Do any of you know, in the Japanese banking system or in their corporate system, is there a less of a obligation on the part of the board of directors and the executive officers to protect the equity than there is in the United States? It would seem to me in this case, Japan may be arguing it wasn't anybody's business. It was the stockholders that were going to lose money and lost money. It isn't depositors, and it doesn't have any effect on their ability to continue the banking business, at least for some period of time. In America, clearly the fiduciary relationship is enormous in that regard, and obviously we don't have the capitalization in our banks, as I understand it. The ratio of equity capital to deposits is clearly not, we don't have great quantities of equity in our banks. Is that not correct as compared to Japanese banks? Or you would...
No, it's the other way around, actually. We
have more
higher
equity?
capital than they.
All right. So is there any difference in the way they treat the equity situation than we do?
I can't speak to the specifics of Japanese law in this area. I can tell you that I read in the wire service reports this morning that there are Japanese shareholders of Daiwa that have instituted suits just in the last few days in the court in Osaka. So my assumption is they believe there's a basis for recovery under Japanese law.
It would seem to me that, you know, to say it's just equity is, I mean, sooner or later it's going to get everybody, I assume, that has anything to do with a bank if you let it go on long enough and it's big enough. Isn't that correct? I mean, pretty soon you'll be bankrupt. Mr. Chairman, I just want to thank you for the hearings, and I have no further questions. Thank you to witnesses.
Well, Senator, I want to thank you for your participation, and I want to thank Chairman Greenspan, Chairman Helfer, Superintendent Levin for coming in. I'm going to ask you, in connection with the inquiry that we did make back on November 2nd, I believe it was, but in the letter which I addressed to you, Chairman, or October 27th, I'm asking you if you would not continue to keep us informed as to those steps that you are taking to see to it that we get even more cooperation from those foreign banks doing business with us, and what further implementation as it relates to additional procedures, reviewing those procedures that you will be taking. And Chairman Helfer, that I'd ask that of you. And I want to thank you for your participation, and we will stand in recess until we have further opportunity to review these matters. Thank you for coming in.
Thank you.